Thank you for coming to our 529 ABLE presentation, the lower cost alternative to the Special Needs Trust. It's important to mention that the Special Needs Trust is listed here, but it is not the only reason why you would invest in one of these programs. There's so much more to it. We mentioned it as being a lower cost option, and it absolutely is, but there is so much more to it. So if you are someone that is not in need of a special needs trust but is interested in um, a 529 ABLE, we suggest you considering sticking around and learning more. So, I am Carrie Waters Schmidt. I am the founder of Equanimity Wealth Planning and Investing. I am the person who you are hearing right now, the voice, and I have a master's degree in financial planning, and I am also a certified financial planning practitioner. So I have CFP as a designation. And what those two things mean to me is that I have a focus on financial planning. I am not someone who wants to look at things with blinders and be just discussing a product with folks. This is a piece to the puzzle. And so, yes, we're talking about a product today, but there is so much more that we can do. So, my specializations are financial planning for unmarried couples and LGBTQ community, and those going through recent divorces or are planning for divorce, and then folks with special needs in their families. And I also offer socially responsible investments, which means that you can specifically say there are parts of the market that you are not interested in investing for, instance, oil, or not wanting to invest in. Maybe the meat industry because you are vegan. Those are things that we can screen out of your investments. And it's one of the things that I do a lot of. And with us today, and you will not likely see her, is Terry Beekner. She came on last August with me. She has been in the finance industry for over 30 years, starting in banking, and then moved on to investments and insurance. She is our Director of Special Needs Planning here at Equanimity Wealth Planning and Investing. And her specializations include 529 ABLEs and trust funding, permanent life insurance, fixed and guaranteed income producing products, long term care insurance, and disability income insurance. So today we're going to start the 529 ABLE presentation here, going over what the 529 ABLE is. And we'll discuss what eligibility is, uses for the program, the impact it has on government benefits, tax benefits that come with the plan, and then we'll compare it with the 529 college plan, which many people are familiar with, and then a special needs trust. And then we will talk about how you get such a plan. So the 529 ABLE account was a result of a 2014 act called the Achieving a Better Life Experience Act. And a few years later, in 2016, the first ABLE account was opened in Ohio. And the act spells out ABLE. So the account often goes by several names, like the 529A or 529 ABLE, or even just simply calling it ABLE. Now, what is a 529 ABLE? Well, it's an investment account. It's a tax advantaged savings program, very similar to a Roth IRA, in that deposits are made with already taxed dollars, and they grow tax free and are withdrawn tax free as long as they're used for eligible expenses. Contributions to these accounts are not counted as income. This is important for all those folks who are in need of qualifying for means tested programs. And we will talk about that a little bit more. So who can get a 529 ABLE? Well, in order to be eligible to get a 529 ABLE, you need to satisfy two requirements. One of them is the disability needs to have occurred before reaching age 26. Now, that is rather young. Uh, there is a change that happened earlier this year, setting the age to age 46, but that is going to be implemented in 2026. So there's quite a few more years until the ABLE can reach more people at that point. And the other requirement is you must meet the disability requirements for SSI or SSDI and are receiving benefits, or if not receiving benefits, get a disability certification from your physician. And that physician would be including the diagnosis that confirms that that individual is meeting the functional disability criteria for the ABLE Act. Now, what we talk about next is who is this eligible person, right? In order to be eligible, we know that the individual must satisfy two requirements, but who might this be? And really, when we think of maybe disability, we think of certain pictures in our minds of what that might be, but it really does include more people than you think. And so I think this is an important time to just discuss that not only might it affect more people than you think, and disability look different than your picture is, but we need to know that this can fit and help more people than maybe we thought. So this is something that can be more widespread because of that. So let's talk about this. We've got injured veterans, survivors of vehicle crashes, accidents, or domestic abuse. If any of that happened before age 26, you can get a 529 ABLE. Autistic individuals, blind or deaf individuals, people with cerebral palsy, spina bifida, Down syndrome, muscular dystrophy, MS, or individuals with some more silent or not visually um, uh, recognizable issues such as bipolar disorder or severe fibromyalgia or schizophrenia, debilitating migraines or degenerative sight conditions. All of these um, issues are qualifying for a 529 ABLE. It just again needs to have happened before age 26. So now let's go on to the owner and how the accounts are set up. So first of all, what is a beneficiary? Well, a beneficiary typically means who this will inherit accounts at the owner's death, right? That's how we are typically uh, aware of what a beneficiary is. But in this circumstance, it's simply referring to the person who is going to benefit from the account. So in this situation, it will be the person who is who this money is going to benefit, and they are also the owner of the account. So in this case, the beneficiary is the owner, and that means that they are the ones in control of the account. If the owner is not capable of managing these dollars, then an authorized legal representative or an ALR can be authorized to manage it. Now, an ALR or this authorized legal representative is someone who is legally authorized under the state and federal law to make decisions for the beneficiary. And you can have someone be selected on the ABLE that can just work in that legal capacity. But you also can have a power of attorney that can be in this role, or a legal guardian or a conservator for the beneficiary as well. And also, representative payees can fit that role. So now let's talk about qualified disability expenses. Now, what's covered by the 529 ABLE is typically basic living expenses. Those are considered qualified disability expenses, or in our world, we call them QDEs. Housing, such as water, sewer, mortgage payments, insurance payments, property taxes, garbage removal, heating, fuel, gas, and electricity is all considered a qualified expense. Employment and support services, education, assistive technology and personal support services, health and wellness or medical expenses, transportation, such as vehicle purchasing or a modification of a vehicle, recreation, like sporting events or concerts, right? We all need a little time away and enjoying ourselves. Clothing can be considered that, dining out, and then other items not covered by government benefits. And legal expenses, financial management and administrative services, and funeral and burial expenses. So, as you can see, it's a very wide list of qualifying expenses. But what happens if a withdrawal is made and it doesn't qualify as a qualified withdrawal? Then the earnings portion of that withdrawal will be charged a 10% penalty, and it will also be counted as income. And because it's counted as income, it can trigger taxes. And it can also be an issue if you are on means tested benefits, right? So you just want to make sure that the withdrawals are considered eligible. Okay, so now it's quiz time. I recognize that I really haven't told you anything yet, but I want you to first think about how these answers might come to play, and basically speaking on how they're going to impact government benefits, because this is a really big concern for folks. So, first and foremost, can a 529 ABLE owner slash beneficiary, they're the same person, remember, contribute part of their income to the ABLE and have that avoid counting as income for means tested programs like SSI or Medicaid or food stamps and so on? I'll have you think about that for just a minute. Can you just earn that money and send it on over to the 529 ABLE so that it will not count as income? And the answer is coming up next. So next, we're going to also talk about number 2, both investment growth and withdrawals from an ABLE. Are they counted as income? Withdrawals and growth from an ABLE are not counted as income. Is that correct? And then third, money saved in a 529 ABLE is counted as an asset or income of the beneficiary for means tested benefits. Is that true or false? Okay, so now we're going to move on. So can that 529 ABLE that owner put money directly earned directly into the 529 ABLE and avoid it being counted as income? No. No, that is false. That cannot be done. The money was earned. It cannot be counted differently as unearned. All right, both investment growth and withdrawals from an ABLE are not counted as income. Is that correct? Yes. Yes, it is. They are not. That's the beauty of the plan. It can grow, and the withdrawals, as long as they're qualified, can be withdrawn without being considered taxable. It's a beautiful thing. How about money saved in a 529 ABLE? Is it counted as an asset or income of the beneficiary for means tested benefits? No, it's not. But this is also a little tricky. It is not counted as an asset and count against you for government benefits that are means tested. But I do want to speak on that here because there is a a stipulation that says your 529 able cannot be worth more than $100,000 and not count as an asset. So any money over the 100,000 is counted as an asset for your SSI payment means testing, and it will count as one of those assets that is the $2,000 or less. So if you have $100,000 balance, um, like I said, that will start counting then toward the outside assets, and it will temporarily suspend your SSI payments. Once you get that balance under the 100,000 or that extra $2,000 worth of assets that are allowable, then it will just start back up again, and you'll get your payments no problem. It should be noted that there is no effect on Medicaid. It's just SSI. Okay, so who can contribute to a 529 able? Anyone, basically. I have grandma listed here or shown here because grandma could do it. Anyone can do it. Contributions can be made by multiple people. The account owner can make their own deposits, friends and family members and employers, even special needs trust or a pooled trust can make contributions to the plan. That is very allowable. But contributions made directly to the plan is way better than having the dollars go straight to the individual and then have them defer the dollars over. So it's really important that you make that a direct contribution so that it will not be counted as income for the account owner. And like we said, contributions, make them directly to the account. We don't want them being counted as income. Now, those contributions that can be made are going to be twofold here. Now, you can have $17,000 can go into this account per year by others. Okay. We said contributions can be made by many different people. The account owner can make them, an employer can make them, family members, like we said, grandma can. But together, it cannot be more than $17,000 that can go into the account per year by all of those individuals. So if grandma gives $16,000, that means whoever else wants to put money into this account, we cannot have another more than $1,000 go into the account. Okay. Now, if the owner is earning money, they can put up to $14,580 additional into this account per year on top of that $17,000. Now, there's tax benefits. Wisconsin residents may deduct their contribution to any states able from their Wisconsin state tax return. This is a big deal. You can put $17,000 into a plan, and it will be deductible off of your state tax. Now, many states offer tax deductions for their contributions. Wisconsin has a plan. It was signed into law, but it's still in development. So because we don't have a plan to offer right now, its own 529 able plan is still being made. Wisconsin will allow you to make a deduction from a state, another state's plan for the amount that you deposited into the able plan for that year. Now, again, if grandma makes a contribution into the account, she lives in Wisconsin, she can withdraw, or I'm sorry, she can deduct the $16,000 that she contributed into the account from her Wisconsin state taxes. That's a big deal. Another extra, it's the Savers Credit. So the Savers Credit is not something that's available to everybody. But for some workers, it is. So you need to be at least 18 years old. You can't be a dependent or a student, and there's a certain income limitation that you need to stick to. So if your income is within a certain number, you're able to make a contribution to the account and get up to 50% of that contribution um, back to you in the form of a saver's credit. So there are maximums. It's $1,000 or $2,000 if you're married, filing jointly, but that's a really great benefit. It enhances the fact that you're already getting a tax deduction from the state, and then on top of it, federally, you're getting a saver's credit. Kind of cool. Okay, so here's a note about tax refunds. Avoiding claiming that tax refund as an asset. That might be a big deal. And if it is, hey, the ABLE can be your best friend. The ABLE can have that money come straight to it. So there is a form that you fill out. It's called the 8888. And when you fill that form out, the tax refund, instead of coming to you, it goes straight to the ABLE. It's a pretty nice deal, right? Because we know that that doesn't count against you once it's there. So if you save your tax refund in the ABLE, the asset is considered for means tested programs only once it's worth $100,000 or more, right? So here, in most realities, it won't be counted against you. So it's pretty nice. So I get this question a lot, and this is something that I've even had some attorneys tell me that they don't like the ABLE because of this. They say, well, what happens if there's money left over in the account at death? Right. And like I said, I had an attorney tell me they didn't like the ABLE because it turns out that the funds do get pulled back if the individual has used Medicaid benefits. So I certainly don't feel that is as big of a negative to outweigh the positive. So first and foremost, if there's money left in there, you can use that money for outstanding expenses and funeral and burial costs. Okay, and let's also not forget that funeral and burial costs are unfortunately quite expensive. I was just talking with a client the other day, and he mentioned that he had, for his wife, 5 years ago, maybe, she was cremated at $9,000, and then it was another 5 or 6,000 for their luncheon, right? So right there, that's a lot of money. So after that point, then if there's still money left over, then Medicaid, yes, it will come in and claim according to how much was paid by them. Then they will, take back that money. If there is still money left over after that, then there is a beneficiary who will receive the funds. So someone will get something, right? And I think that's really important to point out, is that we need to first say, who is this for, and what is the purpose of this account, right? So I would like to say that it's probably to ensure your family member has enough money for all the things that they want, right? Or, I mean, I guess you could be the person saying that you're making sure that Medicaid gets nothing. And if that's the case, well, then maybe this isn't the program for you. But let's say that you just want to make sure that asset is there for your loved one. That to me seems like a bigger need than the potential that the money goes away. And like we said, if there is money still left over after Medicaid has their share, then someone else still gets it. So, this can be a really powerful program that is not entirely for naught if there's money left in there. Now we're going to do some comparisons. So we've Many of us have heard about the 529 college plan. So I'm going to put that up against the ABLE. Basically, a 529 college savings plan says you can put money into the account without taxation, or I'm sorry, you'll have paid taxes on the money going in, but the growth is without taxation. And the withdrawals are without taxation, as long as the withdrawals are used for tuition, supplies, and room and board. And what's cool is the 529 says yes, all of those same things and pretty much almost everything else. So, if you have a 529 college plan set up for your child or yourself or whomever it is in your circle that is disabled, that's great, fabulous. That program will do very nicely for college expenses. If you are on the fence about whether or not you want to start one of those and you already have an ABLE, just know that the ABLE can do exactly the same thing. Okay, so I'm going to just take it a step further and say, can we use those two together? Oh my goodness, yes, please. Please, please. Like we said, the 529 ABLE says that lots of different things can be used and qualified as a qualified withdrawal. And so it covers lots of things, but there are stipulations on how much you can put into it, right? Whereas the 529 college account, there really isn't a maximum. I mean, it's a lot. It's like usually $300,000 to $500,000 of a maximum that can go into that account, right? So if you've got so much money and you want to get it into these tax favorable investments and you want them to go towards the betterment or enrichment of this person, I would say utilize them both. They both do a great job. And they're just a little bit more focused towards what they benefit with. And the other thing I should mention too is that you can move money from a 529 ABLE, I'm sorry, a 529 college account to a 529 ABLE. Okay, so if you save too much in the 529 college account, you can slowly move that money over from that account to the ABLE and still have it benefit them, but obviously in different ways. Now we're going to look at the special needs trust versus the 529 ABLE. There's pros and cons for everything, right? They are similar. In that they both allow for income and assets to be excluded for most or all federal and state aid means testing. But if a recipient also receives too large of an amount from his or her special needs trust, it can disqualify them from future SSI payments. So that's kind of a big deal right there. Let's see, as far as differences, there are plenty of differences. Growth within the ABLE account is tax-free. That is not true in a special needs trust or other pooled trusts. In that case, they would be taxed at the trust rates, which are higher than individual rates. Then income within a special needs trust is also taxable. And so that makes trustees reluctant to make investment changes due to capital gains, or maybe it makes them not want to have investments in income producing or dividend paying funds because they will be taxable. So it can lead to investments becoming overly risky in hopes of avoiding those taxes. And special needs trusts or pooled trusts, they are prohibited from spending money on housing expenses. It's not the worst thing or the only, it's not a hard and fast rule, but it does come up against you and bite you if you do it. So it does not do that in the 529 ABLE. Now, the special needs trust, you can put a whole lot more money into that than you can in the 529 ABLE. Like we mentioned, again, I have that stupid 2022 number in there. It is a $17,000 maximum for this year. And you can only put that much in, right? Whereas in the special needs trust, there is no annual maximum, and you can only change the allocations in that ABLE 2 times per year. Now, in the special needs trust, you can do it as many times as you want. It might be taxable, but isn't as many times as you want. In the 529 able, like we mentioned, that's got the tax-free growth. It can include housing, and you can deduct the contribution from your state return. There is Medicaid payback in some special needs trusts there are as well. And then in the case of having an account worth 100,000 or less, there is no means effect on means testing benefits. Now, special needs trusts can be tricky. Okay. And the reason why I'm mentioning this is, like we said, those withdrawals, they can be too large and they can disqualify you from SSI. And if you use the funds um, for food or shelter, it can be considered in-kind support and maintenance payments, which means that that is counted against you. And so that may not be the best place to pull dollars from for those purposes. So again, can those be used together? And I'm going to say, yes, do it, do it. Special needs trusts are a great estate planning tool. They are wonderful for giving the individual a place to withdraw, I'm sorry, a place to inherit large sums of money. Okay, that's great. And it is something that is wonderful for long term investments because, like we mentioned, as long as they're growth oriented or they're going to be in there for a good long time, there isn't huge tax implications. I mean, there are some, but not huge. Now, the 529 able, though, is great as being a current while you're alive or while they're young and working. Independence enhancing tool. I use these for young folks, especially if I know that I've got a client whose child is under 18. We've got tons of time to put money into this, and the benefits are going to be huge because the money will grow in there over time, right? And as that's happening, like we mentioned, as long as it's used for a qualified expense, you will not be stuck paying any tax on it. So the longer you can let that money grow in that account and be eventually used tax free, the better. But you can still use those dollars now if you wanted or needed to. Okay. As we mentioned before, what if I make too much money and we can't even be eligible for SSI or Medicaid? That's okay. And that's not a bad thing. We talk a lot about how this plan is great for making it so that you can still qualify for means tested benefits. But there's not too many people in the world that I would say you don't want to have an investment vehicle that would grow without taxation and would give you tax-free withdrawals. That is an enormous benefit that is great for anybody. So even if you're not using this so that you can have assets and still qualify for other benefits, this could still be a really, really beneficial tool. So now I'm going to talk about how to get this able. Like we said, they're available in all states. Most states have their own plan. Wisconsin does not at the moment, like we said. So you can use an out-of-state plan if you'd like. You just need to make sure that it allows non-residents in there. So not all plans are allowing you to get into them. There are 29 plans out there that allow non-residents to get into them. So there are two main ways of doing this. You can do it unassisted. There are plenty of folks out there that have started a 529 plan all on their own, and they've gone online, they've looked through all the different plans, and then picked one and just went with it. And that is fine. There is one currently assisted version. So there is a plan with a company called American Funds. Many investors know of who they are. They've been around since the 30s. They're very respectable and very reputable excuse me, they have a great plan in place, and that would be assisted with an advisor. So I could help you with that plan. And so, if you feel like you are comfortable doing it on your own, I do have at the very end a resource list of places that you can go so that you can find more listings of who is out there, whose plans are out there, and then you can check on them and see if they'll take non-residents, etc. Again, if you're wanting to work with an attorney, most any licensed professional should be able to help you. It is kind of a different animal in respects to other types of investments. So you may want someone that knows what they're doing with these plans. But like we said, the Virginia plan is with American Funds, and that is currently the only assisted program out there. I would like you to compare all of your plans before you jump into one, because there are many differences. There are maintenance fees, and they can range between $30 to $60. I know that American Funds has a $10 annual fee, but they have waived that. They have been waiving that, and for the foreseeable future, they also plan on continuing to waive that. So, but check, make sure you know what your plan's maintenance fee is. They may require a minimum contribution. Okay, some of them also require you to make ongoing contributions, and that may not be comfortable for you to commit to such a thing. Debit card availability, if you feel like that is something that is important. If you wanted this to be debit card available, know that, like I said, some of them have them, some of them don't, some of them charge for debit cards. So be, just very watchful of that. We need to make sure that the plan that you're going into offers the appropriate amount of risk. And the reason why I say that is there are plans out there that only offer really quiet, maybe savings account styled investments. And that's great if you plan on using the money right away, right? We don't want anything with lots of variability in it. But if you're trying to save for a young one, and this is a long-term view, you'll probably want something that has a longer track, or a longer view on it, which would be a little bit more aggressive, right? So that is something that you need to make sure fits, because vice versa, if you get into something that only has long-term stuff, investments in there, and you're wanting to use it soon, right, at some point, you want to make sure that you don't have to sell in parts of the investments while maybe the market is down. Right, that's what you get when you're in risk. Is if you need to make the withdrawal and the market's down, that you still have to make the withdrawal. So, making the sales at the wrong time could be very impactful on the long-term viability of this money being there for what you need it for. And then if you have a preference for working with an advisor, the advisor, like we mentioned, can only really help right now with one plan. The other thing I want to mention is there are extra fees that sometimes are sneaky. So I've seen some charge for paper statements. And personally, I'm a paper person, even though in this business we're trying to get everyone to do everything electronically. I am a paper person. Give me a paper statement, please. And yet, in some cases, that is charged for. So here's how you can contact us. We're going to go through some questions and answers, but this is the sheet I'm going to give you, this resources sheet. It's got the ABLE NRC, the National Resource Center. That is a fabulous website, and they have lots of webinars and other things on it too that are really great. The IRS has a website page that is just for ABLEs that you may really like to read up on some federal and state government benefits there. We talked about the form 8888. Did I say too many eights? I'm not even sure. That form would make it so that you can have your refund directly sent over to an ABLE. The Savers Credit, there's a form 8880 that is something you can find directly on the website of the government's IRS website. who qualifies for the Savers credit. And then we have other info on the state of Wisconsin's Department of Revenue, and that tells us about ABLES, including which states have 529s and which do not require residency. So that's a really great resource also.